Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 10.3 of Unit 10, Trading Psychology. In this lesson, we're going to cover the importance of having a trading plan and how to build one. By the end of this video, you'll understand how to create a plan that works for you and help you achieve your trading goals. Let's get into it. A trading plan is a written document that defines exactly what you trade, when, and how. It's like a roadmap that guides you through the markets and helps you make informed decisions. So, what should you include in your trading plan? First, you need to decide which currency pairs you want to trade. This could be based on your knowledge of the markets, your risk tolerance, or your trading goals. For example, if you're a beginner, you might want to start with major pairs like Euro to US dollar or US dollar to Japanese yen. Next, you need to determine which time frames you want to trade on. This could be based on your trading style, your schedule, or your market analysis. For example, if you're a day trader, you might want to focus on shorter time frames like the 1 hour or 4 hour chart. Now, let's talk about entry criteria. This is the set of rules that determines when you enter a trade. For example, you might have a rule that says you only enter long trades when the price is above a certain moving average or when the RSI is below a certain level. Your entry criteria should be based on your market analysis and your trading goals. For example, if you're a trend follower, you might want to enter trades when the price is breaking out of a range or when it's trending in a certain direction. Risk rules are an essential part of your trading plan. These rules help you manage your risk and avoid significant losses. For example, you might have a rule that says you never risk more than 1 to 2% of your account balance per trade. This means that if you have a $10,000 account balance, you would never risk more than $100 to $200 per trade. You might also have a rule that says you never have more than 3 to 5 open trades at any given time. This helps you avoid over-leveraging your account and reduces your risk of loss. Now, let's talk about entry checklists. An entry checklist is a set of rules that you follow before entering a trade. This helps you ensure that you're making informed decisions and avoiding impulsive trades. For example, your entry checklist might include things like trend direction, support and resistance levels, risk-reward ratio, and stop-loss level. By following your entry checklist, you can reduce your risk of loss and increase your chances of success. Having a daily routine can help you stay on track and make informed decisions. This might include things like checking the economic calendar, reviewing overnight price action, and identifying key levels. By following your daily routine, you can stay focused and avoid distractions. For example, you might start your day by reviewing the economic calendar and identifying any major news events that could impact the markets. You might then review the overnight price action and identify any key levels or trends that you need to be aware of. Now, let's talk about the review process. The review process is an essential part of your trading plan. It helps you evaluate your performance, identify areas for improvement, and make adjustments to your plan. For example, you might review your trades on a weekly basis, looking at things like your win-loss ratio, your risk-reward ratio, and your overall profit or loss. By reviewing your trades, you can identify patterns and trends that can help you improve your performance over time. Having a plan removes emotion from your trading decisions. When you have rules, decisions become mechanical, not emotional. This helps you avoid impulsive trades and stay focused on your goals. For example, if you have a rule that says you never enter trades during certain hours of the day, you can avoid the temptation to trade impulsively during those hours. By following your plan, you can reduce your risk of loss and increase your chances of success. The key truth is that the traders who succeed long-term are the ones who follow their plan on the hard days too. This means that even when the markets are volatile or uncertain, you stick to your plan and avoid making impulsive decisions. By following your plan, you can build discipline and consistency, which are essential for long-term success. For example, if you have a plan that says you never risk more than 1 to 2% of your account balance per trade, you can avoid the temptation to over-leverage your account during times of high volatility. In conclusion, having a trading plan is essential for success in the markets. It helps you define what you trade, when, and how, and removes emotion from your trading decisions. By following your plan, you can build discipline and consistency, which are essential for long-term success. Remember, the traders who succeed long-term are the ones who follow their plan on the hard days too. So, take the time to create a plan that works for you and stick to it, even when the markets are challenging. Let's look at an example of a successful trade. In this example, the trader followed their plan and entered a long trade when the price was above a certain moving average. The trader then set a stop-loss level and a take-profit level and waited for the trade to play out. By following their plan, the trader was able to avoid impulsive decisions and stay focused on their goals. The trade resulted in a profit, and the trader was able to build confidence and discipline. Finally, remember that building a trading plan takes time and patience. It's not something that you can do overnight, but rather something that requires effort and dedication. By taking the time to create a plan that works for you, you can build a strong foundation for long-term success. So, be patient, stay focused, and remember that the traders who succeed long-term are the ones who follow their plan on the hard days too. That is everything for Lesson 10.3, Building a Trading Plan. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.